You're looking at a company that just told the public something almost no fast-growing business ever gets to announce. In January of 2026, OpenAI's own finance chief wrote that the company's annualized revenue had crossed $20 billion, up from roughly $2 billion 2 years earlier. That figure describes the pace of income at a single moment, stretched across a year, rather than money already collected over 12 months, and the company has been careful to say so itself. Hundreds of millions of people were using the product every week, and tens of millions of them were paying for it. By the normal logic of a technology business, this is the moment you ease off, stop building, and let what you already own start printing profit. OpenAI did the opposite. In that same letter, the company argued that further growth increasingly depended on securing more compute, often years in advance, before anyone knew exactly who would pay for it. Before getting to why, it helps to see what OpenAI is actually selling, because it isn't one product with one price. A casual user chats for free. A Plus subscriber pays a flat monthly fee, however much or little they use the model that month. An enterprise customer may sign a custom contract built around security, support, service-level commitments, and predictable access, rather than a simple per-message price. A developer calling the API pays per token, which means that slice of revenue rises and falls directly with usage in a way flat consumer subscriptions never do. Each of those relationships pulls on the company's compute in a different pattern, and OpenAI has also begun testing ads on its free and go plans, adding another monetization layer around its highest volume, lowest paying consumer traffic. None of this is a detail. It's the first real decision that commits money, because the mix between these tiers determines how much capacity gets reserved for high-volume, everyday traffic versus the smaller, specialized workloads that enterprise and API customers run. Start with what the product is actually made of. ChatGPT looks like software, the kind of thing that costs almost nothing once it's built. That was true for spreadsheets and word processors. It has never been true here. Every reply, every generated image, every line of code the model writes, every task an autonomous agent now carries out on someone's behalf consumes real computing capacity sitting in a real building, drawing real electricity from a real grid. The company's own numbers make the link explicit. Between 2023 and 2025, OpenAI's computing capacity grew from about a fifth of a gigawatt to nearly 2 gigawatts, roughly a tenfold jump. Annualized revenue grew by almost exactly the same multiple, from $2 billion to over $20 billion. That parallel movement doesn't prove one caused the other, and OpenAI has stopped short of claiming it does. What the company argues, in plain language, is that compute has become the binding constraint on how fast it can grow. More capacity, in its own account, means faster adoption and faster monetization. Less capacity means growth slows down before cost ever becomes the limiting factor. So the decision that actually matters was never about pricing or advertising. It was about capacity, and much of it had to be committed before the customers who would eventually use it had signed up. Outside a mid-sized city in West Texas, construction crews broke ground on a data center complex in the middle of 2024, working around the clock across more than 1,000 acres, eventually planned to span roughly 4 million square feet. By the following year, OpenAI said the site was already running early training and inference workloads, even as more buildings kept going up around the ones already active. That single site is one piece of a much larger commitment. In September of 2025, the Wall Street Journal reported a separate 5-year deal with Oracle worth roughly $300 billion, securing 4.5 gigawatts of capacity starting in 2027. The next month, restructuring its relationship with Microsoft, OpenAI agreed to buy an additional $250 billion of Azure cloud services. Layered underneath both sits Stargate itself, the joint venture with SoftBank and Oracle announced in January of 2025, targeting $500 billion in data center investment over 4 years, with SoftBank holding financial responsibility and OpenAI holding operational responsibility. These are 3 different kinds of obligation, not one number to be added together. But they describe the same underlying pattern. A company locking in power it expects to need in the future, priced today, well before all of that future revenue exists. Here's the part that reframes everything else about this story. OpenAI is not simply buying servers. It is buying the future before it knows exactly what that future will pay. A multi-year contract with a cloud provider turns a forecast into a commitment well before the demand behind that forecast has fully shown up. The forecast might hold up, it might not. Either way, once that capacity comes online, it has to attract enough customers, products, and efficiency gains to justify the next round of spending, because the next round is typically being negotiated while the current one is still under construction. Pull back too early, and a company risks giving up capacity and the customers who would have used it to whoever keeps building instead. Keep building without improving the underlying economics, and a company can end up needing fresh outside capital just to hold pace with a race that never quite resolves into a finish line. That's the trap in the title. Made specific. Not that OpenAI is technically incapable of pulling back, but that pulling back protects cash in the short run while risking the revenue and market position that cash was supposed to defend in the first place. The scale that makes this trap tighter, not looser, is the part easy to miss. When OpenAI announced $122 billion in newly committed capital in March of 2026, closing at a valuation of $852 billion, it also disclosed that weekly active users had passed 900 million, with over 50 million paying subscribers and more than 40% of revenue now coming from enterprise customers. That is not a company running out of demand. It's closer to the opposite problem. Every new enterprise account, every agent that now runs continuously through a workday instead of answering one question and stopping, adds sustained load rather than a single quick request. Success multiplies the exact thing that's already scarce. A company that wins more customers has to find more capacity to serve them, and that capacity carries the same years-long lead time whether the demand behind it arrived on schedule or early. Growth doesn't relieve the pressure in this business. It reproduces the same pressure at a larger scale, running on the same clock as before. That clock is largely outside OpenAI's control, which is what separates this from an ordinary spending decision. A data center needs land, chips, transformers, a substation, and a connection to a power grid that was never built with this kind of load in mind. The International Energy Agency has estimated that without faster, coordinated investment, roughly 1 in 5 planned data center projects worldwide could face delays, with new high-voltage transmission lines in advanced economies typically taking 4 to 8 years to build, and with equipment like transformers and turbines increasingly backlogged as every AI company chasing the same build-out competes for the same handful of manufacturers. No check, however large, shortens a permitting queue or an equipment order that's already backed up for years. Capacity needed in 2028 has to start moving through approvals now, based on a guess about demand that hasn't shown up yet. Wait until the guess is confirmed, and a company arrives at the moment of proven demand with nothing built to serve it, watching whoever guessed first take the business instead. Now look at what all that buying actually costs against what's coming in, because this is where the trap stops being theoretical and starts showing up on a balance sheet. Financial documents reviewed by the Financial Times and described as audited covering the 2025 fiscal year show OpenAI booking just over $13 billion in revenue against total costs and expenses of $34 billion, producing an operating loss of nearly $21 billion. These are reported figures OpenAI itself hasn't confirmed publicly, so the exact digits deserve some caution. But the shape of the gap lines up with everything the company has said about its own spending. Research and development alone reportedly ran close to $20 billion, more than the company's entire revenue for the year, and the same documents put total payments to Microsoft at roughly $17 billion spread across several accounting categories, though the reporting itself is careful about exactly what each category represents. Tripling revenue in a single year is a genuinely rare achievement in any industry. It still left a gap that operating income alone hasn't closed, and that outside capital has been what covers instead. That dependency, more than any single number, is the mechanism actually deciding whether this company controls its own future or keeps renting it one funding round at a time. That dependency would be a private problem if OpenAI were racing only against its own ambition. It isn't. In May of 2026, Anthropic announced a $65 billion funding round at a $965 billion valuation, alongside a revenue run rate that had crossed $47 billion, up from roughly $9 billion less than a year earlier. For a stretch on paper, a direct OpenAI competitor became more valuable than OpenAI itself. That single fact tests the thesis of this whole story better than any speech from either CEO could, because it proves the race isn't a framing device invented for a video. Two companies selling fundamentally similar products are locked into raising capital, buying capacity, and chasing the same enterprise customers on overlapping timelines, and neither can afford to slow its own build-out without handing the other an opening. If OpenAI eased off infrastructure spending to protect its balance sheet while Anthropic kept building, that gap wouldn't stay theoretical for long. Enterprise customers weighing a multi-year contract pay close attention to which vendor is still investing at the frontier and which one is pulling back. It's worth being precise about what that comparison does and doesn't prove. Anthropic's own revenue figure is self-reported, covers a different mix of consumer and enterprise business, and comes with its own unresolved losses. One company briefly outvaluing another on paper doesn't settle who wins in the end. What it does settle is simpler and more useful. Neither company is choosing this pace of spending in isolation. Each is responding to what the other is doing, which means either one slowing down unilaterally functions less like prudent management and more like forfeiting ground in a contest that, so far, has rewarded whoever keeps building. So is there a way out of this that doesn't just mean spending forever, hoping revenue eventually catches up? There is, and it's the one real counterweight to everything said so far. Compute gets cheaper over time, and sometimes dramatically so. Stanford's AI index found that the price of querying models that reached GPT 3.5 equivalent performance on the MMLU benchmark fell from about $20 per million tokens to roughly 7 cents in under 2 years, a drop of more than 280 times. If that kind of efficiency curve keeps bending the way it has, and if OpenAI routes routine tasks to cheaper, smaller models while reserving expensive frontier capacity for the work customers will actually pay a premium for, the company doesn't need revenue to outrun spending through growth alone. It needs the cost of serving each task to fall faster than the number and complexity of tasks keeps rising. Picture two lines racing inside the larger race, the cost of doing one unit of useful work on one side and what a customer will pay for that unit multiplied by how many units get requested on the other. Whichever line is winning decides everything else in this story, including whether the current spending eventually turns into an ordinary, profitable software business or an obligation that never stops requiring outside financing. Total compute demand depends on two moving variables: how much computing power a single task requires, and how many tasks people and their agents request. Total compute spending adds a third variable on top of that: what each unit of that capacity actually costs under OpenAI's own contracts. Efficiency, the kind Stanford's data points to, can push the first number down. Longer agent runs and more demanding requests can push the second number up. Whether the savings from one keep outpacing the growth in the other isn't a settled question yet. It's the actual contest hiding underneath the more visible one involving funding rounds and valuations. That contest forces a real choice, not just a hopeful bet. If efficiency isn't winning fast enough on its own, a company in this position has only a few honest levers left. It can lean harder into the tiers built to bear more weight, pushing further into enterprise contracts and metered API usage while asking the newly ad-supported free tier to start covering more of its own way. It can get more selective about which tasks get routed to the most expensive frontier models at all, saving that capacity for work customers demonstrably value enough to pay for. Or it can keep raising outside capital and hope the first two levers eventually catch up. The pattern of OpenAI's own spending and fundraising suggests it is leaning on more than one of these levers already, which is itself a signal that no single one has proven sufficient by itself yet. Run the strong version of this forward, and the picture looks entirely survivable. Efficiency keeps compounding roughly the way it has over the past 2 years. Cheap, routine tasks route automatically to cheap infrastructure, while premium tasks fund the expensive frontier work that keeps OpenAI ahead technically. Enterprise revenue keeps climbing past its current 40% share, and agents start doing work valuable enough that businesses pay meaningfully more per completed task rather than per simple query. Partners like Microsoft, Oracle, and SoftBank keep absorbing a real share of the physical build-out instead of leaving all of it on OpenAI's own balance sheet, Contracts retain enough flexibility to adjust if demand comes in lower than forecast and outside capital shifts from being fuel. The company can't survive without into a tool it uses selectively on its own terms. In that version, the operating loss visible in today's leaked financials narrows year over year instead of widening. Revenue per unit of compute keeps climbing, and by the time the next major contract comes up for renewal, OpenAI is negotiating from a position where investors are competing to fund it rather than the other way around. The fragile version doesn't require any single disaster, which is exactly what makes it worth taking seriously. Revenue growth cools by a few points as the first wave of adoption matures and easy converts run out. A competitor cuts prices to defend market share, the way price wars tend to unfold once more than one credible option exists for the same enterprise buyer. Tasks get more complex as agents take on longer jobs, consuming more compute per request than the simpler chat traffic that built the current revenue base. Some contracted capacity could land early and sit underused, a cost that depends heavily on how flexible those contracts actually turn out to be, and some could land late, missing the exact window when a wave of new customers needed it most. None of that is a catastrophe by itself. Together, it means the next funding round gets negotiated from a weaker position than the last one, at the precise moment OpenAI's leverage has quietly eroded. In that version, the gap between revenue and cost doesn't close so much as get refinanced, quarter after quarter, on whatever terms the market will still allow. That's the fragile outcome worth watching for, not a company that runs out of users, but one that never stops needing the next investor to keep its current customers served. So return to the moment this story started with, the choice to slow down and finally convert years of growth into visible profit. Follow the money through the contracts, the competitor, the physical limits of the power grid, and the falling cost of serving a task, and that choice reads very differently than it did at the beginning. Slowing down doesn't just preserve cash sitting in a bank account. It's a bet that today's product stays valuable while a well-funded rival keeps building without pause, while enterprise customers keep signing longer contracts elsewhere, and while capacity that took years to secure sites waiting for a green light that never arrives. Nothing about that bet is doomed, and nothing about it is guaranteed. It depends on variables the company can influence, like how fast it drives down the cost of a task, and variables it can't, like how quickly a rival keeps raising capital or how fast a turbine ships. OpenAI can choose to leave this race at any point it wants. What it cannot do is make the race stop running without it.